Welcome to Investing in Startups. I'm Joe Maker. Our guest this week is David Zhou. David's an investor in emerging managers, an angel investor, a blogger, and the host of the Superclusters podcast. We talked about how LPs can size up emerging managers, how VCs can stand out, portfolio construction, and which of sourcing, picking, and winning is the most important for emerging managers. David's a good guy and a really thoughtful investor. Please enjoy. David, thanks for coming on the show. We normally have VCs on the show, and I thought it would be fun to have someone on who has experience as an investor, but also on the LP side of the table, and particularly around emerging managers and a lot of depth and perspective there. And so I thought maybe to get rolling, you could just introduce yourself to folks with maybe talking about your background and Superclusters and what that involves.
Yeah. I'll share the shorter version of the story, but effectively, I was born and raised in the Bay Area, was very fortuitous in having that, being surrounded by entrepreneurship and technological innovation. Went to school very quickly and loved the idea of like building things. So became a founder and operator pretty early on. Jumped into venture in 2016 after we had an exit with one of our companies and focused on consumer and marketplace investing while I was in venture for a long time. And I've always loved working with people who have a chip on their shoulder. And so that meant in the venture investing world, pre-seed and seed, really pre-seed as the primary focus. And I love being first check-in. And so a lot of my angel investments and a lot of my venture investments in which we had made, we were, I think last I checked, it was like 70% of my investments was when I was like first check, not like first round in, but like first check-in, which has always been really exciting to me. And about 3.5 years ago, I don't know when this episode's going to go out, so it might be 4 years at that point, I found myself getting really curious around capital entrepreneurs. So still entrepreneurs, but instead of a technological product, they were building a fund, a strategy. And so these were folks who were starting their fund ones and fund twos, emerging managers, and spent a lot of time helping them get their fund off the ground. A lot of things that they probably wouldn't consider, like what goes in the data room, what's a cybersecurity policy, how do you build like an information policy, but also like if you were to hire your first non-investment team member, what does that look like? Usually, if you're an emerging manager, your first hire is like an analyst, associate, principal kind of thing, an investment professional that helps you out, hopefully grows into a partner at some point. But the second hire you make is like a COO, CFO, something along those lines. And like, how do you actually look for one and how do you design one around that? So I got more into that. And over time, in the last 3.5 years, have started deploying into funds as well. And Superclusters, to your question earlier, was born out of personal curiosity. I am by no means a classically trained LP. I was more or less like classically trained as a VC, but I wanted to learn and think like a sophisticated LP. So when I wrote my first LP check, I literally went to a bunch of my GP friends like, hey, can you introduce me to your most helpful LP and B, the LP that you have on speed dial, right? Who's the one you go proactively to and who's the one you go reactively to? And I was introduced to 80 allocators over the course of 2 months, learned a lot, put out a blog post based on the learnings in which I had, and that went viral, called the Non-Obvious Emerging LP Playbook. Mostly to scratch my own itch. It was supposed to be my artifact of like, this is what I use to learn to be an allocator. But that had gotten so much momentum that a lot of people were asking, hey, why don't you start a podcast? Like people don't read these days, do a podcast. But it took me a while to be convinced. But there were 3 people in particular that gave me the activation energy to start the podcast, which is Superclusters now. That's where I spend time asking dumb questions to really smart people, but specifically to allocators to educate first-time and emerging allocators.
Awesome. Well, your blog is great, and I want to ask you some around that. And on your point of asking stupid questions, that's part of the joy of the show, right? Having your own shows, you get to have really smart people on, and you get to ask them questions that otherwise you wouldn't get to do. You wrote a couple of essays recently. You've written a lot over time. We call them posts. I'd say an upmarket term for posts, we'll call it essay. But 2 that really stood out that go as a pair. One was Dear Emerging Manager and the other was Dear LP. And I'd say they both have some straight on the nose, tough love advice for both. And they start with, Dear Emerging Manager starts with, you are not all top quartile. And Dear LP starts with, you're not special. What was the spark for writing these? They get warmer, by the way, for anyone. I'd encourage people to read them. But what was the spark for writing these?
It's actually funny that you mentioned, you're right. I hope they get warmer over the course of reading that. But sometimes when you're eating medicine, you just want to know it's medicine and you don't want to be like, oh, like we're including some sugar in here and all these other additives in here that sounds good, but eventually you still eventually find out you're eating medicine. So I thought serve medicine upfront and cold as quickly as you can. So that was kind of the thesis behind those posts. A couple things. Actually, when I wrote the Dear Emerging Manager one, which came out first, I had about like 5 or 6 friends who immediately texted me and like, David, is everything okay? Like, should we talk about something? Scared for my psyche for while I was writing it because they were rather sharp elbowed in the approach to writing it. So what started was we're now sitting in late 2025. And this was especially even more true in 2020 and 2021, where everyone was saying like, I'm the most amazing picker out there. And we were in like the absolute bull market ZERP environment. There were less fundamentals when people were telling others of like, hey, I'm a really great fund manager. Nowadays, we sit in a point in time where we see so many fund managers on PitchBook. I think that there's like 4,800 active funds out there. Based on some friends and internal databases, we see about 9,000 active funds. And I'm sure that's not the complete market either, right? Like there's more than 10,000 out there. Just there are certain programs out there that are minting hundreds, if not thousands per year in terms of emerging managers. And for those listening on audio, I just use air quotes. And there's a lot of that. And everyone cites the same old kind of metrics, which are Carta, AngelList, PitchBook, Cambridge, you name it kind of thing, where first of all, there's availability and survivorship bias on these platforms. The people who are sharing their data on these platforms are often those who are going out to market to raise their next funds. That's one. The second of which does not account for valuation methodology. And this is something that I sit down with, let's say, most managers I'm with, which is they say, hey, I am a top quartile TVPI 2022 vintage sitting at 1.5x, let's say. And I go like, really? Tell me about how you value your companies. And they go like, well, it's last round valuation. I'm like, okay, 2022, I can give you some grace of, you can hold some at last round valuation. But what about this one company that raised in 2022, but hasn't gone back to market? We're 3 years out and they haven't been repriced. Do you think they're still worth last round valuation? And of course, these fund managers go, of course they are. They're growing really quickly. I'm like, tell me about how fast they're growing. Oh, they're growing about 5% a year. I'm like, that's not quickly at all. And the last round was valued at 50x revenue multiple. Do you still think they're worth 50x revenue multiple? Because by the time they go to public, let's say it's a SaaS company or an enterprise company, right? The average SaaS company, I think, I haven't checked the Q3 numbers on this, but like Q2 numbers were like, they're sitting around like 7.79x in terms of revenue multiples. So about 7-8 kind of X. So 50 is a large margin. And we also have to count as early stage investors that there's the day one bump. But as early stage investors, our shares are locked up for another 6 months. So how much does that regress back to the mean after day one, month one kind of bump? And that's something you have to calculate as well, because that's what your exit is if you're looking for a public exit. All that to say, I was frustrated by the number of conversations I've had and the lack of discipline that a lot of emerging managers had. Some of them just didn't know, which is totally fine. Like it's better not to know than to know and intentionally like build your numbers otherwise. But for those that didn't know, I thought this would be a good educational tool. And hopefully a lot of the blog is anything that I think I need to say more than once, I will write it on the blog. And that will be a public artifact, hopefully to educate the audience on, I wouldn't call it best practices, but things that people should consider. And so that's how Dear Emerging Manager came out. After I wrote Dear Emerging Manager, I had a lot of emerging manager friends who were like, hey, there's a lot of bad practice in LP land. You should write one about LPs.
I figured that's how that piece came around. I was like, I bet he got a bunch of texts from emerging managers who had a bone to pick. So
absolutely. And so I got that. And the straw that broke the camel's back, which to be fair, the 2 essays came out in pretty quick succession. I would say like 2-3 weeks apart from each other. The straw that broke the camel's back was I jumped on a call with a friend of mine and she was all like, David, I need to get something off my chest. Like, I don't need advice. I know what I should have done here. I know what should have happened here. I just need you to hear me out for this interaction I recently had with an LP, which for lack of better words, was less than good of a practice from the LP side of the table. I was like, holy freak. Okay, you're right. I do need to write something. And I kid you not, as soon as we ended that call, I wrote probably 80% of that Dear LP post in the first hour after that. And then the next like 20% was just like fine tuning it in the few days that came after that. And that came out, at least at the time of this recording, last week.
What's the biggest misconception that emerging managers have about LPs?
That's a good question. That everyone has money to deploy, that everyone has decision-making power. Again, I don't know if that's the biggest misconception, and there's probably recency bias in my answer right here. And I'm speaking on behalf of a couple friends who have yet to tell the managers they've been engaged with that they no longer have capital to deploy for this year. Let me caveat with this year. Like there's a pacing that we all have as LPs. And similarly enough, like, GPs have their own pacing as well. Like we're in November now of this year. Most folks would have already figured out who they're deploying into, and they have maybe like one or two more checks they still want to write. And of those one or two more checks, they've been in conversation for the last 6 months. So truthfully, like any net new manager we're talking to, probably less interesting. And I think it's really important to understand the incentives, but also the timelines that different allocators are on. Certain sovereign funds, right? They build their budget cycles in November. There are certain sovereign funds that build their budget cycles in April. And so effectively, if you want to get an investment from any of these, let's say Japan per se, who builds it in April, you should probably engage in conversation around February, March before they set their budgetary cycles. So then you can be top of the docket when they actually go out to deploy capital. That's one. Let's say fund to funds, they usually determine by fiscal year. So it's like, hey, you know what? We begin in January, February, and then we slow down our pacing near the end of this year. And it's usually into like quote unquote obvious managers. So understanding all those things, how I generally, and this is something I've always had on my CRM, which I find to be useful framing for once upon a time, I was on the IR side, meaning I was like in investor relations, I was fundraising for capital. That I found to be helpful was there's a column in my CRM that categorizes everyone, LPs, by their Maslow's hierarchy of needs. Like there's the usual stuff you have on a CRM. There's the email, there's the name, there's the whatever last meeting notes, location, all these other things, check size, all that. But I have a few columns in my CRM that are unique to my way of thinking. One of them is the Maslow's hierarchy of needs. And for those unfamiliar with that, there's like 5 levels to this. At the very bottom level, it's physiological needs. Like it's getting a job. It's like, hey, I need a place to live, things like that, right? Putting food on the dinner table. At the very highest rung, there's self-actualization. And the layers in the middle, from physiological needs, there's safety, then there's love and belonging, there's esteem, then there's self-actualization. Most LPs sit on, realistically, the love and belonging to self-actualization, right? For the most part, I don't think, unless they're a junior allocate, this is the first job out of college, for example, then they'll be worried about, safety and job security and all that. But because of how long our timelines and cycles are, it's a pretty safe and comfy job for the most part. Most allocators are in the love and belonging, esteem, self-actualization. Self-actualization are folks who are like the heads of the family, they're CIOs, they can make pretty strong decisions and they're unilaterally like, it's their decision to make. Folks on the love and belonging, they're probably like folks who are like the principal level, the vice president level, who are like, hey, you know what? I need to figure out the one deal that will get me promoted. I need to figure out like, what's this pacing I need to do to jump into another institution. It could also be next gen family offices who are like, hey, I've been defined by my last name for the whole time. I want to be defined by my first name. What is the deal that's going to put me on the map? What is the thing that I need to do that's going to put me on the map? And depending on where they are in the Maslow's hierarchy of needs, their motivations are very different. Their decision-making algorithm is very different. So tailoring yourself to that is, I think, a smart way to approach fundraising conversations. And for the most part, outside of a couple of professional investors, let's say folks who have the CFA, CPA, CAIA, MBA kind of backgrounds, most people, if they're the originators of wealth, if their full-time job might not necessarily be investing, so to speak. So these are high net worth individuals, family offices, potentially people who cover other asset classes. They never want the first conversation you have with them to be a fundraising conversation. It's like, let's have a get to know each other conversation. But I think too often a lot of managers jump straight, and this is true for a lot of founders talking to VCs as well. The first conversation they have, they go like, Joe, great to meet you, small talk in the beginning. And as soon as the first 5 minutes are up, they're like, Joe, can I tell you about my company? Can I tell you about my fund? And they spend the next 20 minutes telling you about whatever they're working on. But that's not a way to build a relationship. I hope that answers your question. I kind of just went on my own diatribe here.
No, that's great. There's an interesting continuum with investment strategies where the more generic the strategy, the fewer the reasons you give an LP to say no. But at the same time, you give them fewer reasons to get excited. Now, to flip it, if you have a completely unique, differentiated strategy, you can go into the too hard pile or in a box that isn't a box, and allocators just don't want to deal with it because it's too complicated or noisy, or they don't want to have to sell it to the person who is self-actualized at the top, as you referenced before. Do you have any advice for emerging managers on how to think about differentiation?
You're right in the sense that the more generic a strategy is, people have been predisposed to something like this. And at that point, they just have to figure out, you don't have to sell them on the strategy, right? I think there are a couple things. First, you have to sell an allocator or an investor of any kind on the market. They have to believe in the market first, right? If they don't believe in venture, the likelihood of you convincing them to do their first venture check, not likely. If they don't believe in emerging managers, the likelihood of you convincing them on emerging managers, unlikely, right? So you need to convince them on the market. And actually, because venture itself is such a broad market, the fact that emerging managers, early stage fits under that, growth equity fits under that, secondaries fits under that, these multi-stage opportunities fit under that. All of this is venture means even if someone is quote unquote in venture, you don't know what kind of venture they're actually interested in. Are they interested in the IBMs of the world, which are the multi-stage platforms that can appreciate 2 to 2.5x in that given fund cycle per se? It's not amazing. In some years, you can get better returns in the public markets. And for the most part, it's, at least to myself, the returns are a little less inspiring. But that said, it's a very stable horse. There's almost no downside risk in these things. That's one type of venture. There's another type of venture that's high octane, high alpha, emerging manager like. You have to convince them on that as well. And most people, when they say, oh yeah, I have venture in my portfolio, you'd be like, hey, when's the last time you did an emerging manager check? Have you done one in the last 12 months? I would even dare say, have you done one in the last 6 months? And of the last 6 months, what else have you done? Have you done a check into someone of my profile? You could be, let's say, an angel turned GP, or you could be a founder turned GP. Have you done one of my profile? If you haven't done one, there are two things. One, you educate them on your background. And it's a lot less of here's the strategy, here's just the experience in aggregate that founders in this example can bring to the table. This is an example where an ex-operator can bring to the table. I joke around with friends quite often, which is the operator moniker, so to speak. Operator turned GP just means you had a previous job. You had a job in tech. That's why you're an operator. But other than that, that's all there is to it. All that to say, educate them first, right? It's the market first, then the industry and strategy, then it's you. And most GPs start off by differentiating themselves first before the LP necessarily has been sold on the market, the strategy, the vertical, right? And so I think it's important to start with that first. If you have a generic strategy, you don't have to pitch them on all these things. It's just hey, sell them on the person. They understand everything else. If it's a more specific, nuanced strategy, you need to sell them on here's what medical devices look like. Let me sell you on why medical devices in general is a really interesting niche. Let me sell you why nuclear energy as a niche is actually a really big market. It can actually allow me to 5x my fund. Those kinds of things, right? But it's less about the fund itself. It's more so let me talk to you about these things. That's one. The other side of this is a framework that I've borrowed from Brandon Sanderson, who is not a venture investor as far as I know, who is a fictional author, a fantasy author. But he talks about this in terms of writing protagonist storylines, which is there are flaws, limitations, and restrictions. Flaws are things you need to overcome within this storyline, this timeline. So for example, Zhou, I'm not necessarily pointing at you, but let's say there's a metaphoric manager out there that doesn't have a track record, has a track record of 2 years of angel investing of 4 deals. The flaw you have to overcome is just you need to get more reps in. We don't know if you've seen enough, right? That's a flaw you need to overcome by fund 1 or an angel fund 0 kind of thing. Then there are limitations, right? Limitations are things that the market tells you you're less than good. So it could be the fact that you're a solo GP and the market decides that solo GPs are less interesting, although personally I love solo GPs. It could be the fact that you are part of an underestimated population and they're well, we just haven't done that many bets for this underestimated population. That's a limitation the market has placed on you. It could be the fact that your fund size is too small. For example, if you're betting on hard tech and you have a $10 million fund and you say you're only going to get diluted by 50% or so, which is a very generous thing for a $10 million fund with a no reserve strategy, then the question comes down to, do you have enough Can you give enough capital? Can you find enough capital for your founders that they never have to raise capital again, or they only have to raise one more round of capital? If you cannot do that, you're going to get diluted by 80%, which is normal-ish. At the same time, it's just like, that's like a limitation where like, I think your fund size is too small. So that's something the market places on you. And it could be specific to each LP. For example, if you're talking to a sovereign fund and their minimum check size is $50 million and your emerging manager fund is $50 million, they're just like, we physically can't invest in your fund because our minimum check size is the entirety of your fund, which is the case in a lot of scenarios. So that's a limitation. And then there's restrictions. Restrictions are things you place on yourself. For example, Batman doesn't kill people, right? That's a restriction he placed on himself. He could kill people, but he decides not to. A restriction that you place on yourself is like your thesis. For example, like I only invest in solo founders. I only invest in founders in a certain geography. I only invest in founders that are building an industrial tech, right? These are all restrictions you place on yourselves. Or it could be the fact like one of the managers I ended up backing, he lives in Hawaii. A restriction he placed on himself is like, I live in Hawaii. And in order to overcome that restriction I placed for myself, I have to frequently travel to these San Francisco, New York, you name it, which he does travel every single week, which is like crazy. I don't think he's at the age where I would be traveling every single week, but he does. But that's something he overcomes as well. And the process of all this, when speaking of differentiation, the reason I use this for differentiation is I think it's always important to talk about the elephants in the room. There will always be elephants in the room. If there are no elephants in the room, you would be raising a $200 million fund one betting on like seed. Right? Seed and Series A, because it'd be really easy for you to raise. And if there were no elephants in the room, you would raise your entire fund in 3 weeks. If you cannot do that, there are elephants in the room, and you have to be intellectually honest with yourself that there are elephants in the room. And I think using that framework better helps you understand, like, is a limitation a restriction? So for example, if an LP goes like, hey, our minimum check size is $10 million. Your fund size is $30 million. We don't want to be more than 10% of your fund size. So that means at most we can put in a $3 million check, but that's like a third of our smallest check size. But the restriction you place on yourself is, I execute my strategy the best at $30 million, which is okay, which is a totally valid strategy. That just means there's no LP GP fit, right? And you should accept that. Right? Other times, is the limitation a flaw? For example, if the limitation is a flaw, like for example, like Joe, maybe you don't have enough of a track record. We expect track records of, I'm making all this up. Like we expect track records of at least 10 years, and you have to do at least 50 investments across 10 years. Then it's like, hey, it's not a conversation for this one. It's an lack of LP fund fit, not an LP firm fit, but an LP fund fit. So maybe fund N+1, N+2 will have that conversation. So that's a part of where I think about like the elephants in the room differentiation on that component. The flip side of this is, let's say you have something that is special. I think too often managers have tunnel vision of like, I am the special pig in the market, right? Most of the time, I'm not saying all the time, but most of the time that is not true. If you just have a couple conversations with other folks in your respective industry, you'll realize pretty quickly your process, your deal sourcing mechanism, your value add is just not as special as you think it is. And so I think oftentimes a lot of this is just like, go talk to 50 other managers or go talk to 20 other managers in your same space, right? If you're deep tech, go talk to 20 other deep tech managers and just be intellectually honest with each other and just be like, hey, do I have something that's special? Because for example, let's pick on enterprise, for example, one of the differentiation things that I see quite often is like, oh, we can help people with sales. Like I have connections to the C-suite or the VPs at big name companies, and I can help get my portfolio companies into these big companies, which is great until an LP starts to do references and all that, like for LPs who have been in venture for long enough and that is their full-time job, they probably built a network already in venture, so they can just get on a phone call and chat with like the VP of Salesforce or something like that, right? And like, hey, do you know this person? Like if they send you a potential like, product in which you use, how much weight do you put on it? And there's all these things, and you realize at some point it's not nearly as special because everyone in this world, in this connected world of social media and just networks in general, is connected to everyone else. But the question is not who do you know, but who trusts what you know and how well do you know each other? And I think a lot of managers underestimate that. So just go talk to others and you'll realize pretty quickly if you're differentiated or not.
Oh, it's true. And I think people underestimate how many smart peers are out there. I'm reminded of something Nikki Shabak from Blackbird told me on the show on talking to LPs. And his view is it's a big waste of time for me to be talking to a potential LP if they don't already share the worldview that I already have. It's a heck of a lot easier to just really pre-qualify the meeting and make sure that it's a good use of everyone's time and you kind of skip ahead to the point of, all right, now we're talking about me because you're already bought into these elements of the thesis. We're already in venture. You like emerging managers. And Yeah. I thought that was good advice that hopefully I'll be able to put to good work myself.
It's actually really interesting that you bring that up. I was giving feedback to a manager recently who asked for deck feedback.
I
And
love the posts you do on deck feedback, by the way, on LinkedIn. They're
thank you.
really good. I'd recommend people check them out. They're good.
I'm still wondering if I should do more of that or less of that, if it becomes a series or if it doesn't become a series. A lot of this is just like raw, unfiltered. It's like literally what I text back to the manager and I just like copy and paste it and post it publicly, obviously abstracting a lot of things that could be incriminating, for example, numbers and names and all those kind of things. But one of the decks that I saw recently was this 30-page deck, which first of all is too damn long. Like I'm saying 30 slides before the appendix. I'm not talking about 30 plus the appendix. I'm talking about 30 and then the appendix. And about a third of that deck was, here's why my space is awesome. And I told him, first of all, is this a reading deck or is this like a pitch deck, right? If it's a reading deck, you can probably get away a little bit with like the education of the market. But it also means that assuming you're talking to someone who knows the market, you're talking down to them. And that is not a good way to start a relationship. The worst offender is if this is a pitch deck. If this is a pitch deck and you're spending a third of your time, which likely not even a third of your time, a third of your real estate, but probably half your time educating them on the market, you should probably bifurcate that conversation to be one, an education conversation and a separate conversation for a pitch conversation. The fact that you're trying to truncate all of that into one conversation effectively means that you're half-assing both. Like, what is that famous Ron Swanson line, which is like, don't
half-ass two things, whole ass one.
Exactly. And you should do that for every single meeting as well. If it's an education meeting, focus on the education. Like sell them on the industry, the vertical that we talked about earlier, right? If they're already bought into the industry, then sell them on you. Like we want to know about you. You don't need to sell me on the industry again. And like, for example, one of the areas I love looking at is just like renewable energy. And so I've spent a little bit more time in the past couple of months like looking into that. But I don't need someone to like resell me on the industry. I'm already sold on the industry. I already love the industry. I want to know like why you're the best manager, why you're the manager I should be picking in that industry, for example. But yeah, that's what I thought of.
You referenced some data recently from Abe Hoffman from AngelList, if anyone who's not familiar, about follow-on data.
Yeah.
And the data point from that study, which he's done and I've read in the past, and I think is a great read, was that funds that never follow on beat always following on funds 63% of the time. What do you think about follow-on, particularly with emerging managers?
You know, before this conversation, you and I talked about, or like, I think you had sent me some prep beforehand, which is like, as an LP, do you prioritize access picking or winning? And I promise this is related to that question as well, which is, as a fund, I think it's different, but let's take a case study. Like the case study is that you were an operator or a founder turned GP. Or like, I guess like we can also take this, let's take a spin out example, actually. Let's say you're a spin out from a large firm, right? You used to be analyst, principal. You worked your way up to like a partner level at that last firm that you're part of. It's a very referenceable firm. It's a firm that everyone knows. And you decided because of economic reasons or strategic reasons, you're like, hey, I would just love to do my own fund. And you start your own fund. And if I, as an LP, were looking at that fund, the biggest thing I try to figure out is access. Because I need to figure out in that situation whether you were a great investor because of your last firm or in spite of your last firm. Were you responsible for a reasonable proportion of your last firm's success? So, for example, if they were like one of the managers I came across recently, part of a really large firm, was a GP at this large firm. The firm itself, I think, delivered in those vintages like 3.5x, and he himself was responsible for a fifth of the 3.5x that firm delivered, which is really meaningful given that their team is like 200 folks. So for him, it was like, okay, well, I see that you won independently of that, but also like you were helped by a lot of folks at the firm, like people who continue to support the portfolio, the people who continue to like, help hire for that portfolio company were all your other team members, not you. You did technically make the investment decision, but not the others, right? And so the question there is a combination of, if you no longer have that brand, how much does your name still hold in weight in the industry? And second of which, like, a lot of founders loved you and your check because of all the portfolio support, the ability to hire an executive, but that's not necessarily an expertise that you have. Is that something you're going to continue replicating? So then I would start looking towards like access and winning as something new. If they were younger on the totem pole, for example, they were an analyst or a principal that spun out, I would look more towards access because they probably haven't put enough bookings in for us to like actually reference their track record. But that's an example. And so the question earlier that you had was, what do I think about follow-on? If the primary concern is access, which is sourcing, then it comes down to, I don't care about your picking ability, because follow-on is really a function of your picking ability. If I think you can pick great companies, I think you should double down on them, kind of thing, right? But if you cannot pick good companies, or you don't have enough of a track record to pick good companies, the big question is, do you see the right deals, right? And if I were to look at your anti-portfolio in a random basket of companies that should be in your industry, did you not see it? Did you not pick it? Or did you not win it? Obviously, as an emerging manager, most of the companies you've come across, or like most of the companies in this anti-portfolio, probably you haven't seen it, right? Which is okay. Like, you don't have to invest in every great company, but every company you do invest in has to be great. So of the proportion, let's say 6 out of 10 happen to be like, you didn't see it, but out of the remaining 4, did you not see it? I mean, did you not pick it or did you not win it? And I need to figure out like which distribution that is per se. And that gives me a better pulse of like, should you have follow-on? Should you not have follow-on? And if you didn't pick it, like, what did you learn in that process? If you did not win it, what did you learn in that process? And that learning ability is really important. So the whole thing that as LPs, especially LPs who invest in more than one vintage for a firm, a big question that we have is, does your deal flow, do you as an individual, does your firm, does your team get better over time? Is this the worst version of the firm that we're going to see ever again? And in that situation, we're kind of underwriting for the potential of where you're going to go. That effectively means that if you don't have follow-on today, do you have the ability or the option to choose if you want to have follow-on later? And so the idea of follow-on is, if the biggest risk that you need to prove out in the current fund, let's say fund 1, is, can I pick? I don't think you should have much of a follow-on, and I think you should have 0% follow-on. If the biggest risk you need to prove out as an emerging manager is, can I win deals? Can I build a value add team? Can I provide value that the founder wants? Then it's worth having a 10, 20% reserve strategy, just to show that, hey, not my founders love me not only for the current round, but also for the subsequent round as well. And so that's more the qualitative approach, going back to what Abe mentioned, like, the data suggests that either always follow on or you don't follow on at all, which is just to show the fallacy of human decision making, because we're prone to emotions and all these other decision making frameworks. A good friend of mine recently told me, which I thought was a really interesting comment, which is he's invested in 50 funds to date. And I asked him, like, how does he decide, like, how does he do re-ups and all that? So it's equivalent of like an LP doing follow-ons. And one of the things he told me was his rule of thumb is he goes to 0 AGMs. He doesn't go to anyone's AGMs. And I'm like, oh, that's an interesting thing, because it's usually like an AGM, an annual general meeting, is something you provide for your investors once a year to show, like, here's the progress of the fund, here are portfolio companies, here's why you should be excited about us. But he doesn't go to any of them because he's like, physically, it's impossible for me to go to 50 AGMs a year. If I go to 50 AGMs a year, I'm just doing nothing else. He's exaggerating a little bit, but quite metaphorically, he's doing nothing else. And because he's doing nothing else, he just can't go to every single one, which means he has to cherry pick which AGM to go to. And so he goes like 10 of them. But if he goes to 10 of them, he's biased towards that 10 because he's built this additional trust with these 10 managers that makes it more likely for him to re-up in those 10 managers. So instead of being biased by all these qualitative things and these relationship things, he just goes to none of them. He reads the reports, he has conversations separately. That's an example. But in the world of follow-on, why that's related is sometimes as a manager, you'll spend a meaningful proportion of your time with a specific company, with a specific founder. Maybe you go play golf together with them. And it has nothing to do with the success of that company or the product in and of itself, but it's just because you've spent so much time with them, you build up this bias of like, oh, I trust this person based on magnitude of time I've spent with them, and he or she hasn't done me wrong by any way. And so I think many managers, emerging managers, are prone to like, oh, I like people that I spend more time with. And they end up making decisions according to that, which is probably not something that LPs want. They want things that are more like, by the time you get to a Series B, Series C, you shouldn't squint at the company. You should know technically like, this is a great company, this is not a great company. But also if you continue to do follow-ons, which is also, there's no one silver bullet here, but as you continue to do follow-ons, the question is, if you continue to do follow-ons at Series B, you realistically probably shouldn't be getting early liquidity in that company, even if it's a great company, until maybe Series E, like 2-3 rounds after, give or take. And the more follow-ons you do, the less opportunity you have to have early liquidity, because there's signaling risk that comes with that. Joe, if you've invested in seed, Series A, Series B, Series C, and now you're selling at Series D, as a Series D investor, is there something wrong with the company? Is there something you're not telling me because you have more information than I do? But on the flip side, if you're only a pre-seed seed investor and you sell by Series C, it's like, well, Joe doesn't have information rights down to like Series B, past the Series B. And that's totally fine. Like Joe's looking for his fund. He's looking out for his investors. He's selling. That's not bad signaling on the company. He doesn't have the information to do that. If you're an emerging manager, I think what Abe mentions is quite astute, which is like you should do all or none. If you've been around the block for a while and you know what signal looks like at a later stage investor, because you have to re-underwrite the company at the Series A, you have to re-underwrite the company at a Series B. If you're capable of doing it, if you have a team of like available to do that, you can opportunistically pick.
If you get data on fundraising for venture, it's very top heavy right now, where a disproportionate amount of money is going to larger established funds relative to emerging. Yeah. And it's always very top heavy. It's just more so than usual. From the perspective of what you see with other LPs, like what is the pulse from LPs thinking about emerging managers today?
It's really hard to make a general statement there. Like, it's even really hard if, Joe, you were to ask me, what is the pulse for family offices on emerging managers? Because as in this world, we understand it's like if you know one family office, you only know one family office, right? And this is similarly true with a lot of institutions. Even if you say endowments, which have in the past been some of the, if not the best LP for venture as an asset class, because they're very long duration patient capital investors. A lot of that is changing based on the endowment tax and how much like the organization is shifting because of that. There is a certain institution that I think most people are familiar with if you've been in the market long enough as an endowment, who has literally in the last 6 months has completely shifted their approach on venture. But historically, they've been probably the most active, or one of the most active endowments, university endowments in venture. And so it is very different. And on the flip side, there's these, for example, I had Trish at Babson on my podcast recently, and they're very bullish on venture, and they're still doing a lot of active and manager checks, and they're like an $800 million endowment. And so it's really hard to make these sweeping comments. That said, I will share a story based on a conversation I had with a friend recently who happens to work at a very large university endowment. And a lot of it goes back to Charlie Munger's line. The story, which is a short one, is I was chatting with my friend on how he does marks. What are marks? And I was like, oh, like all these marks suck. Valuation methodology from emerging managers, like they hold it at last round valuation, or they even like mark up their safes, which is a big no-no in the world of venture. But that said, most LPs don't know this, or most LPs don't look as finely into it. And he told me, he's a good friend, but also it's a good reminder of Charlie Munger's line. And he said, if you're a new manager of mine, I'm going to scrutinize your marks like hell. I'm going to be like, hey, are you holding at last round valuation? Are you preemptively marking things down? How much are you marking them down? And what is the revenue multiple on that? Of the safes in which you have, like, are they all priced markups? Or are they like, convertible note markups? And so he's going to be heavily scrutinizing on those things. And he's going to spend time on there. On the flip side, if you're an existing manager in our portfolio, ignorance is bliss. I don't want to know. Like, don't tell me. Like, I won't ask you about it. Don't tell me how you're doing your marks. Just show me good marks, because I get paid on what my TVPI is. And so it's a tale of two cities in that sense, right? Like, same outlook on venture per se. But in many ways, it's just like, are you net new or are you an existing one? All that to say, it's going back to Charlie Munger's line, like, show me the incentives, I'll show you the outcome. That's where it is right now. I think the only thing I can share right here, at least in terms of the overall outlook on LPs, is how is that individual you're talking to getting paid? Are they getting paid on IRR? Are they getting paid on TVPI? Are they getting paid on building a portfolio from scratch? Do they have a 6-month, 1-year, 2-year probational period to do so? Do they have the trust of the institution or the family office to make these wide sweeping changes? What does their track record look like? Based on those things, and based on where they sit on the Maslow's hierarchy of needs, to come full circle here, that's probably how you should approach the conversation.
What's something you've changed your mind about in the last few years?
So there's like a personal one, there's a professional one. Personal one. I think I have a pretty sensitive palate when it comes to eating food in general. This is going to be the death of me potentially. But for a large part of my life, I just didn't like dairy. The dairy was not like charcuterie boards and anything that had like a lot of dairy products in it. I was like, forget it. Like I could just, I'll eat the meat. I won't eat the cheese kind of thing. But as of late, I've been to a couple establishments as well as my partner has eased me into dairy complementing certain dishes is actually quite interesting. So that's like a personal thing that I've changed my mind on, that I've now consumed more dairy than I used to. Don't get me wrong, I collect my calcium and iron in other ways, but I do understand that dairy for a long time has not been the forefront of my mind. And then the professional one, I think for a long time, I've been averse to solo founders and solo GPs, largely because for like the obvious reasons that the industry says, right? Key person risk, like Joe, if you got run over by a bus, I'm like, what the hell do I do with my fund investment? But in the last few years, and this happens with a lot of managers out there, but there's co-founder breakups, partnership breakups, and all that. Having seen some of those, one within my own portfolio and then a couple among like friends' portfolios and just friends in general, I see the range of how messy it can be and how much it distracts a manager from actually doing the work we've paid them to do.
I have a good friend who's gone through a breakup with a co-founder as a GP. I know exactly what you're talking about. It sounded like a really messy divorce, a business version of it, and I'm sure it had to be incredibly distracting.
Exactly. And you're spending a disproportionate amount of time, probably the majority of your time, especially your mind space, thinking about that, stressing about that, building anxiety around that, that distracts you from investing in great companies, helping great companies. And over the years, I've been a little bit more excited about like solo GPs, just because if you get hit by a bus, like it's done. Like we know exactly what happens. Like it's the rest of it. Hopefully all the investments are made by then. If all the investments are made by then, we just decide when to shut down the fund by LPAC approval or majority LP approval. Or if it's not, investments haven't been all made by then, return the capital back to your investors. And that's it. That's all in the LPA. There's very clear legal frameworks around this versus not very legal frameworks around partnership breakups. There's no prenup for partnership breakups. So anyways, I've been more excited about solo GPs as of late.
Yeah, no, it's a great point. And then I think if you compare it to the actual number of times there is a real hit by bus with a solo relative to just a falling out between partners, I'm guessing the hit by bus is a far lower number. And as you said, far more solvable. We talked about the access picking winning earlier, and we talked around it, but I don't know that I pulled out of you, if you had to rank them, access picking and winning for an emerging manager, how would you do it? Why?
I'm going to go with the median in the sense that, and this is all anecdotal, because most of the managers I talk to are former operators and founders and angels, as opposed to spinouts. I mean, I still talk to a decent number of spinouts. I think I was looking at my CRM earlier this year. I think I talked to like 60 spinouts this year. So it's still like a decent number of spinouts, but I talk to so many more operators and founders who turn into GPs. And so because of that anecdotal deal flow in which I have, to me, access matters a lot more. And the reason I say access matters a lot more is most of these folks, they're like, hey, I'm making all these names up, but like ex Google or ex Netflix or all these like great companies, or I was part of like, I would say more so like operators who are like, hey, I was a part of this community that had this thing. And that's given me a lot of deal flow. I get invited to like YC demo day. I'm like, okay, you're like the millionth person who's told me you have access to YC demo day. And then you're probably like the 100th, if not like 1,000th person who've told me you have access to like pre-YC demo day or alumni day and all that. All that to say is I want to know that you're seeing a lot of deals that you could be in your respective industry. I have a bias towards specialists. I have invested in some generalist funds, but I have a bias towards specialists. And at least in being the specialist in your industry, I think one of the cardinal sins that you can have over time is just not to see the deal. Like, it's okay if you don't pick it and win it. Like, as long as the process works, as long as the decision-making algorithm is repeatable and scalable and you can put faith behind that, I think the worst thing that can happen is you don't see the deal. And so I want to know that you can see the deal in interesting ways, either earlier or in broader scope. Whether that means you use AI tools, whether that means you build a community, whether that means you host events, I just need to know that you see the deals, and hopefully you're one of the first to see the deals. And only after that depending on your check size, then I care about the other two. For a check size of fund one being under 500K and under, picking's a lot more important as number two. If you're building a firm where your check size is between 500 to 2 million to start things with, winning matters a lot more because you're actively squeezing somebody else outside of the round. So if you're like somebody's raising a $3 million seed round and you're writing a $1.5 million check, the founder actively has to choose, do I want Joe or do I want someone else? And I want to know that you can win that deal. I need to know why the founder would take that deal from you. So it does depend on that as a function of check size. But I think in aggregate, overall, with some exceptions, access matters a lot more to me.
What's a conventional view in venture that you think is BS?
I think there are a lot. Cold emails don't work. Only do warm intros. I don't believe that. Like, I've built a lot of my network through cold emails. I've seen other people build their network through cold emails as well. Build enduring friendships through cold emails. I think it's just a lack of thoughtfulness. There are other conventional views where it's like concentrated versus diversified. I wouldn't say any is bullshit. There are multiple ways to make money, but I think the overall consensus, at least in my experience, is that concentrated is better than diversified for a bunch of reasons. And I'm not saying that concentrated is necessarily worse than diversified. I have a bias towards concentrated myself, but I think most people who champion these conventional views don't put as much thought into it. It's like, oh, I do this because the industry believes this. It's because I was at a conference recently where I was moderating a panel, and it was a panel about family offices and all that. And the study that is always cited, actually, I don't think most people actually know the year that study was done, but it was a 1987 study, which said that the first generation makes the money, the second generation spends the money, the third generation loses the money, right? And it's like, by the second generation, people have already spent like 70% of that. And then by third generation, like only 10% of that family's net worth is left based on the first generation. And this study that's cited on and on and on, these numbers that are cited oftentimes, but I think most people haven't thought critically about it. And I think with most conventional wisdom, just think more deeply on it. Like, think about first principles. Like, one of the conventional wisdoms right now is like low entry prices matter. So like, everyone's championing these like, oh, I get it on a sub 10 valuation or like a sub 15 valuation, which I think is like an important thing because in the world of investing, it's buy low, sell high. It's not necessarily buy lowest, sell highest. It really depends on what the exit value is and what it takes to the portfolio construction of that. I think ownership is interesting, like to have like, oh, I have 7.5% ownership in a company, but then it gets diluted down to like 2% over time or 1.5% over time. I think it's good, but I think what's more important, at least in constructing a portfolio, is how the portfolio sizing, which is if you're doing 20 investments, you need a 20x to be a fund returner. If you're doing 100 investments, you need a 100x to be a fund returner. And so I think that matters a little bit more than ownership, but I think ownership is prioritized a lot in these situations.
I love that. Thanks for coming on. This was super fun. Hopefully we can do this again in the future, but this was great.
This was so fun. Joe, thanks for having me on.
Thanks for listening to the show. We really appreciate the support and would love it if you'd subscribe to the podcast on iTunes, Spotify, your preferred podcast platform. One more thing. Investing in startups is not of sponsors, but I want to give a shout out to one of our portfolio companies, Micro One. Micro One helps businesses ranging from startups to enterprises to source world-class software engineers. Micro One uses their own AI tools to identify top 1% engineers and get them working for customers in as little as 48 hours. And if Micro One could help one of the largest AI companies in Silicon Valley hire 250 engineers in 30 days, they can probably help you too. If you'd like to learn more, visit microone.ai, and thanks for listening.
Zhou Mega is the founder and managing partner of Seaplane Ventures. The content here is for informational purposes only and should not be construed as investment, legal, or tax advice. The opinions expressed by guests are their own and do not reflect the views of Seaplane Ventures. Our host, guests, and clients may hold investments discussed in this podcast. Please invest responsibly.